In 2019, WeWork, a global darling of the tech world, commanded a private valuation approaching $47 billion, an astounding figure that few financial models could rigorously justify. Today, we dissect the financial anatomy of its precipitous decline, unraveling precisely how the WeWork collapse explained a critical lesson in corporate finance regarding the perils of unchecked ambition. This catastrophic implosion was not merely a story of charismatic founders or cultural excess. It was a brutal demonstration of how a company's operational vulnerabilities, once amplified by an unsustainable capital structure, are utterly exposed by shifts in the global economic landscape. But beyond the headline figures and the charismatic founder, the fundamental question persists: was WeWork's core business model ever truly viable? Or was its entire edifice simply a product of an unprecedented era of cheap capital, destined to unravel the moment financial gravity reasserted itself? WeWork's peak valuation dwarfed that of established, profitable real estate giants, yet its underlying business was consistently hemorrhaging cash. At its zenith, the company's enterprise value was north of $47 billion, fueled by staggering capital infusions primarily from SoftBank. Fast forward to November 2023, and WeWork filed for Chapter 11 bankruptcy protection, disclosing liabilities estimated between $10 billion and $50 billion. This was a company that, by the third quarter of 2023 alone, reported a staggering cash burn rate of $296 million, with cash and cash equivalents dwindling to a precarious $205 million. The operational reality stood in stark contrast to the aspirational narrative. The primary financial mechanism of failure was a critical asset-liability mismatch, structurally baked into WeWork's business model from its inception. The company effectively became a massive real estate arbitrage play, signing long-term, fixed-cost lease agreements for physical office space, often spanning 10 to 15 years. These long-term obligations represented an immense fixed-cost liability on its balance sheet, creating an inherently rigid cost structure. On the revenue side, WeWork offered flexible, short-term memberships to its customers, typically month-to-month or annual contracts. This created a severe duration mismatch: long-term, fixed-price liabilities against short-term, variable-price revenue streams. As long as capital was cheap and demand for flexible office space surged, the model appeared viable, masking the underlying risk. However, the operational unit economics were consistently inverted. The cost of acquiring and servicing each square foot of space often exceeded the revenue it generated, even before accounting for significant overhead. The company's return on invested capital, or ROIC, remained stubbornly low, consistently struggling to cover its weighted average cost of capital. This fundamental imbalance meant that WeWork required continuous, massive infusions of external capital just to cover its operating deficits and growing lease obligations. Its interest coverage ratio, a key metric for evaluating a company's ability to pay interest expenses on its outstanding debt, deteriorated precipitously as its debt load increased and profitability remained elusive. In a market environment defined by low interest rates and abundant venture capital, this was sustainable, or at least perceived to be. WeWork essentially arbitraged the cost of capital, securing funds from eager investors at high valuations to subsidize its negative operating margins. The critical boardroom capital misallocation can be traced back to WeWork's aggressive global expansion strategy, propelled by a seemingly endless supply of venture capital, notably from SoftBank's Vision Fund. $5 billion into WeWork at various valuations, culminating in the $47 billion peak. This capital was deployed at an astonishing pace to expand its physical footprint across 38 countries and over 700 locations, often at premium lease rates in major urban centers. Management, under Adam Neumann, prioritized growth at all costs, frequently signing new leases without sufficiently robust projections for occupancy rates or profitability. For instance, in 2018 alone, WeWork's total lease obligations surged by 80% to $34 billion, a direct consequence of this rapid, unmeasured expansion. This decision to exponentially scale a fundamentally unprofitable unit economic model, funded by increasingly large and expensive capital raises, created an insurmountable structural vulnerability. The company's cash flow from operations was consistently negative, meaning it generated less cash from its core business than it spent, making it entirely dependent on external financing to simply stay afloat. This aggressive leveraging of fixed liabilities, without a corresponding increase in profitable, predictable revenue, was the direct catalyst for its subsequent downfall. The pursuit of hypergrowth led to a bloated organizational structure and extravagant spending on non-core ventures, further diverting capital from its primary operational needs. Millions were spent on private jets, a wave pool company, and even an elementary school venture, all while the core business burned through cash. These capital allocation decisions were not strategic investments in long-term efficiency or core technology, but rather aspirational expenditures that further exacerbated the company's financial fragility. When the market sentiment shifted, particularly with the looming IPO attempt in 2019 revealing the company's true financial state, the tap of cheap capital instantly ran dry. The live restructuring synthesis reveals a harsh economic reality. The pre-bankruptcy WeWork business model, as executed, was indeed an artificial byproduct of cheap credit and speculative venture capital. The core flexible office concept itself has fundamental market demand, particularly in a post-pandemic world requiring adaptable workspaces. However, WeWork's historical capital structure and aggressive operational expenditure model were fundamentally unsustainable. The company's November 2023 Chapter 11 filing in the District of New Jersey initiated a comprehensive restructuring of its balance sheet. This process involves terminating or renegotiating a significant portion of its over-market rate leases, a move critical for shedding its most onerous liabilities. The focus is now on streamlining its operational footprint and seeking to convert its massive debt burden into equity, effectively wiping out previous equity holders. The outcome is not a validation of the original fantasy valuation, but a stark concession to market realities. What remains to be determined is whether the surviving entity can find a viable path to profitability by operating a drastically smaller, more efficient network of flexible workspaces, unburdened by the previous era's financial excesses. The current restructuring involves the rejection of approximately 150 leases out of 700 globally, a direct consequence of the previous capital misallocation and the unsustainable lease terms. This action, while painful for landlords, is necessary to bring the company's fixed costs in line with its actual revenue-generating capacity. The economic arguments are clear. A business model that requires perpetual external capital infusions to cover its operating expenses is not fundamentally viable. The market forces, particularly the abrupt shift in interest rates and investor appetite for growth at any cost, simply exposed the inherent flaws that were always present. The $47 billion valuation was not a reflection of intrinsic value but a speculative bet on future capital market liquidity that ultimately failed to materialize. The core flexible office business may yet survive, but it will be a leaner, more disciplined entity, a shadow of its former, over-leveraged self. The notion that a technology company could perpetually outrun gravity by continuously raising capital at ever-increasing valuations, regardless of underlying profitability, has been thoroughly disproven. The market has delivered its verdict. While flexible workspace has a role, its profitability is constrained by traditional real estate economics, not the limitless potential often attributed to software. The collapse serves as a critical case study in the immutable laws of finance, where unit economics ultimately dictates survival, not aspiration. If you seek deeper insights into how strategic error transforms into balance sheet devastation, watch our deep dive into FTX's implosion next, where similar forces of unchecked ambition met the cold reality of market fundamentals.